Hello and welcome to Chapter 7 of our course on quantitative trading. Today we're going to look at the topic of quantitative risk management. We've seen how hedge funds try to target constant risk in a strategy using probability scaling. But what if a fund is running many strategies across hundreds of thousands of assets? We need a picture of the total risk exposure across the firm. We can target different horizons, but the formula for tomorrow's price loss or gain will be P&L equal to the sum over the assets of the number of contracts of each asset multiplied by the price move in that asset. This is the loss distribution that we want to understand. We want to know what's the probability that we lose a certain amount of money. So in order to understand this loss distribution, we need a good model for the prices. Given that we have the profit and loss distribution, there are two standard metrics used to report the risk: the value at risk and the expected shortfall. The value at risk is the amount we expect to lose at the alpha percentile, and the expected shortfall is the expected amount we expect to lose in the tail of the distribution given by the alpha percentile. If I run through the mathematical definitions here, if X is the profit and loss distribution, then the value at risk is defined in terms of this infimum. Whereas the expected shortfall is the integral over the tail of the distribution of the value at risk. The expected shortfall has some nice mathematical properties that value at risk does not. In particular, it's what's called a coherent risk measure. You can look this up and find out more information online. Estimating the expected shortfall in practice is much harder as it requires good modeling of the tails of the distribution. In layman's terms, the expected shortfall is the average amount you expect to lose on a day that is as bad or worse than the alpha percentile. Now we've seen the two most popular risk metrics in trading, we can ask, how do we compute them? In practice, this is challenging. Understanding the loss distribution requires modeling a high-dimensional probability distribution over all the assets with a limited amount of data. But there are three standard approaches: the historical, the simulation, and the variance-covariance. The historical method involves bootstrapping empirically, whereas simulation involves modeling using Monte Carlo, and the variance-covariance method involves estimating volatility using the variance and covariance. For an example, we demonstrate how to compute the value at risk for a strategy trading a single COMEX gold future with a look-back period of 3 years and bootstrap sampling. This is using the historical method. Here we repeatedly return we sample 100 returns from the last 3 years and compute the loss at 5%. This is then used to give an estimate of the loss at 5% with some confidence bounds. So here I've written the KDB code, and you can see that at the 5th percentile, the estimated loss is 1.8%. So we expect our gold future to drop in value by 1.8% at the 5th percentile. So you could say that once a month we expect a loss of at least 1.8% from our position in gold. Thanks for listening. That's been a very brief introduction to quantitative risk management. It's a fascinating subject and there's much more to learn.